Lula asks, "Hi Matt, I am new to self-directed IRAs. My money has been sitting in my account for over a year now. I'm interested in buying real estate in the form of rental properties. I'm not sure how to go about it without losing my money. Please help."
Lula, thank you for your question. I would say that the best thing that you can do to mitigate your downside risk, okay, and protect yourself against losing money is to buy a property that is already performing, okay? The biggest risk points are typically when you're buying a distressed asset, okay? You're buying a property that's in a distressed condition, and then you yourself are trying to oversee the renovation of that property and the improvement of that property, which all kinds of things can go wrong. It can take much longer than you expect. The repair and maintenance costs can be much higher than you expect. There might be, a lot of times you buy a property at foreclosure auction and, you can't even get inside the property until after you buy it. And so there may be more things wrong with the property than you expect. There's all sorts of high risk variables associated with, trying to do all of those types of steps yourself, especially if you don't have an advantage in that marketplace. You're not an expert. You don't have the relationships and the resources to execute that at a professional level. And so the way that you can mitigate that risk is to put all of that risk on somebody else. Let somebody else buy the property. Let somebody else do all the renovation with all their own money and everything. Let somebody else incur the initial vacancy period while they're leasing it out to a tenant and getting a qualified tenant in the property paying rent. And then you just swoop in once the property is already performing, meaning it's already been completely renovated, meaning that it's already has a qualified tenant and they're paying rent, and you just evaluate the deal. Okay, you just do your due diligence on the deal. So you send your third-party home inspector in there to inspect the property. You verify, all the monthly expenses. You do your, title search, all the regular due diligence that you would do buying a property. You're just mitigating your upfront risk by letting somebody else do the high risk stuff, and then you just come in and you already know how the property is performing, right? So there's not a question about can it rent for this much, can it not, because there's already a tenant in there paying that rent, okay? So you would want to verify that that tenant is in fact paying the fair market rent, and that if they leave you can rent it for that much to another tenant. You would want to verify that you're buying the property at or below fair market value, and you can do that. You can get an appraisal, you can get a broker price opinion and look at closed comparable sales, and the same thing with with other rentals in the area. So all that information is available to you, but you want to put yourself in a position where you are evaluating, you are verifying, you are doing your due diligence, and you are making a decision. You are not the one who then has to take all of these high-risk actions in the future that have, consequences that, could go any number of ways. You're going to evaluate a performing property and decide which performing property you want to buy. Now, in real estate, there's always some level of risk. You're going to have some level of vacancy. You're going to have some level of repairs and maintenance. You're going to have, those are non-fixed variables, okay? So you can't 100% control and secure everything with a real estate investment, but by buying a performing property, what you're doing is you're dramatically mitigating your upfront risk getting into the deal.